And in my opinion, when you're pitching a specific deal or a business or something very specific, the level of your excitement translates to their belief.
This podcast is for educational purposes only. Nothing you hear on this show is legal or investment advice, nor is it an offer to buy or sell securities. Always consult your own legal and financial professionals before making decisions. Welcome to the Capital Flow podcast, where our conversations help capital raisers and fund managers create flow in their capital, their business, and their life by learning from those who've built systems that attract resources instead of chasing them. If you've raised $5 million or more, this show is for you. Each week, we dive into the systems and stories of real capital raisers who attract investors through trust, systems, and relationships. And today, I'm excited to welcome our guest, Dan Kinder here. Dan is a good friend. He's a user of Capitalist Pro. And fortunately, we were able to catch him while he was in town visiting family. So really excited to get into your story, Dan, of how you spent nearly 30 years in the corporate world and then transitioned into real estate and business. So without further ado, I'm your host, Dallon Schultz. Let's get into the flow. Dan, thank you so much for being with us today.
My pleasure. Thanks for having me.
So Dan, share with our listeners a little bit about your background. And you spent some time, quite a few years in the corporate world, and just a few years ago transitioned out of that. So why don't we start there and we'll get into it.
Yeah, several years ago, happened right after COVID. Corporate world is very wasteful in a lot of ways. And
wait, say that again?
The corporate world's very wasteful.
Just want to make sure people.
Very wasteful. I was on the team, last guy on the team that had his hand raised, said, like, this is the wrong way. We need to really think about what we're doing. And they basically said, shut up, sit down, and don't come to any more meetings. I thought I was going to get fired.
Because you're a numbers guy. You're a financials guy.
I'm a numbers guy. We do financial systems. That's what we do. And they were just going the wrong direction. Everybody else had their head down in the corner. Just tell me what to do and I'll do it. And I'm the last guy that said, and they said, shut up, sit down, don't come to any more meetings. You're like, you already ruined the team. It's not me. And so I started looking for other things because I thought I was going to get fired. Not because I wasn't productive, just because I was
you were going against the
attitude.
Man.
Exactly.
Attitude.
A year later, they threw $4 million in the trash can. Started all the way from scratch, all the way over.
Man.
But before that happened, I was open. If that had not happened to me, I would not be open for something different. To coincide with that, there was a lot of pressure to get the COVID vaccine. I know there's both sides to that equation, but on October the 8th, they said, you got 2 months to get approved or get the shot, or you're going on leave. And I got approved the day before the expiration date, December the 7th, and I was already wide open. That puts a lot of stress on you. I was looking for other jobs. I was looking for just about anything because I knew, based upon HR conversations, that it wasn't going to go good. I didn't have good feelings about it. I got approved. I didn't have to take the shot.
It's because they realized they couldn't force you to do it.
I told them I'm ready to meet my maker. The worst part about that, and the worst part of corporate America is, I finished the conversation with the HR guys, and I said, "Can I have a copy of what you're going to send to a panel for approval?" They said, "No, you can't have that. It's confidential." I'm like, "It's my information. It's confidential to me." They wouldn't let me have it. So I was done. I'm like, I'm looking for something else. The following weekend, I get an email from this guy named Grant Cardone. Never heard of him before. I don't know what you're about. $97 for a real estate summit. I've been in single family rental for 20 years, 1997, year before I got married, 98. Gutted a house, rebuilt it. I knew real estate, but Grant Cardone, $97. Okay, what do I have to lose? Paid $97 on Monday morning. Within 15 minutes, I'm like, this guy is full of something. It ain't real. And I was pointing at the screen. It was all virtual. I'm like, what is going on with this guy? He's trying to sell me something. What are you trying to sell me? Total disbeliever. I mean, skeptic is not the right word. Cynical is the right word. And I'm really not sure why I went to day 2. I'm like, this is really, he put out enough examples. I'm a numbers guy. If that's real, whoa.
So you didn't buy into what he was offering because of his personality. And for those that know Grant Cardone, people either, it's very polarizing. It's like people either love him or they hate him. But you being a numbers guy, after so many case studies, after so many testimonials, after so many numbers showing that it works, that's what it sounds like. That's what locked me in. That's what locked you in.
Those numbers locked me in. I'm like, I don't know. I just don't know if that's real. And I still didn't know what he was selling. But I'd never heard of the word multifamily before in my life. And I was very curious. I had, 10 single family homes at that point, rentals. And by day 2, he's throwing more examples at me. And I'm like, there's no way. I used to day trade, swing trade. I do my homework. I know financials. Like, I've never heard of such a thing. What in the world is a syndication? I thought that's what you did on TV when you do reruns.
They're like I always interpret it as like a crime syndication. Whenever I heard syndicate, I thought of like a crime. Maybe that's my Italian upbringings.
I don't know. It was a foreign word to me. I didn't know what that meant. And he described it. And I'm like, wait, you can double your money in 5 years? Well, that'll blow the stock market right out of the water. I had some good years stock market trading. And the 1 year that I didn't have a great year, I was done. You work so hard for 9 months and then one mistake with no stop loss and you're in the negative for the year. I just got tired of the stress, man. It's too much.
So for those that might be newer to raising capital, real estate, business, syndication it's a pretty universal term once you get into this world of raising capital. But for those that might be newer to this industry, share with them, explain with them essentially what a syndication is.
Yeah, the really simple way to explain it is you gather other people's money, what Grant calls OPM, and they're limited partners, they're silent partners. You use their money to buy an asset of some sort, and then there's a smaller portion, usually 3 to 5 people who manage or oversee that investor money to oversee the asset to whatever, most in this space see the value add proposition as you buy an apartment complex. Well, you can't buy an $18 million apartment complex by yourself. So you go out, raise $6 to $10 million, you buy the asset, you rehab it, increase rents, increase the value, sell it. It's like a giant house flip.
I was always under the impression that these large apartment buildings were owned by one really rich person, but it's not. It's through these syndications. It's through groups of people coming together in a partnership and getting into something much bigger than what they could do on their own.
That's right.
Up to that point, you had been participating in single family rentals, homes. Right. I know a lot of people that do that very successfully. And I'm not saying one is better than the other, because I know people that are crushing it in literally every asset class in real estate and business. But I think it's finding the vehicle that aligns with what you're looking for and what makes sense. And as a numbers guy, the economies of scale, being able to pool resources and get into something that mitigates risk and has more potential to drive value, right, that just made sense for you. And that's what got me into the real estate game a few years back as well, is just understanding that. So you attended this training. It was a $97 training. You went into it, you're like, who the heck is this guy? What are you trying to sell me? He showed enough case studies and numbers, and you're like, okay, now I'm sold. So tell us what happened after that.
Yes, it was a 3-day summit. Monday, I was calling him a liar to the screen. By Tuesday, I just couldn't believe that I had missed it. I'm open to lots of other financial instruments and tools, and I just couldn't believe that this was real. So I did some checking. Tuesday evening, coming into Wednesday, that's when he made his pitch. It was a real estate club. You come in, we'll help you, we'll walk you through it. You'll see lots of deals, so on and so forth. And I knew on Wednesday he had changed my life. The most I've ever spent in my life is $22,000 on a brand new Chevy Avalanche. Never spent that much money in one time. $25,000 is what the rate was for join for 1 month. And I wrestled with it in my mind. I talked to my wife. I said, I don't understand why I've never heard of this before, but I believe it. I'm all in. I know my life's fixing to change. I don't know how fast. And so the best part about I joined his club. The best part about it is I got to see 2 or 3 pitches every single week. I learned within a month the good and bad aspects of what's a good deal and what's a bad deal. This is back in 21, 22 when there was a lot of action. Mm-hmm. There's not much action today because of interest rates. There was a lot of action. And analyze it, look through it. About month 3 or 4, I already understood and knew underwriting. It can be challenging for some people, but for me, I'm a numbers guy, Excel guy. It came easy. I was so ramped up. I didn't even know what I was doing, to be honest with you, from a capital raising perspective. Raised $750,000 from friends and family, put it in 3 deals. I thought at that point, Grant does not push the general partnership side, who manages the syndication. He was pushing mostly, I got you covered, man. Bring your money to Cardone Capital. Sure. We got you covered. And so that's what I saw. Actually, interestingly enough, a lot of people get super nervous. I was crazy nervous. The first time I'm getting ready to send and wire $300,000. Whew. You think $25,000 is a lot of money? That I was sweating bullets, man. I'd like, is this real? The worst thing that could have happened to me, I sent the money, I wired it on a Tuesday night. The bank didn't wire the money. Called me at 6:00 that night. Aren't you closed? Don't you know people are suing this guy, Grant Cardone? I'm like, hold on.
Oh, jeez.
I'm the one that's wiring the money, man. I appreciate your concern. Please wire the money. Next morning, funds get wired. I'm 5 investors short. I missed the window by 5 investors. Okay, what does that mean? I was unhappy. I'm not in the deal. Took about a week or so. His next deal's probably a couple months away. Who knows how long? So I'm disappointed. I pull back out. I like, just send the money back, man. It was a good experience because the pressure. Everybody who ever considers raising money, you have to go be an LP first. You have to be a limited partner. You have to know what it feels like to push that button. It's not easy to push that button, especially the first time. I'm going to send $100,000 to this guy that I know. I think I know him, but what if my money disappears? You got to know, man.
And that all comes down to trust. So I wanna pause here because there's a lot of things that have come up in what you just shared with your first experience here that I think a lot of people experienced and new to this industry just need to be aware of. And at the start of this podcast, we'll always have the disclaimers that we're not financial advisors or attorneys. But I even like to just reiterate this in live interviews. If anyone is looking to raise capital, consult with a securities attorney first.
Absolutely.
So, but let's get into this process, because those that know Grant Cardone, they know he's a sales guy. He's high energy, right? And he's been able to build a strong brand. And there's a lot of value that he's able to provide as well.
He's so frank, though. That's what attracted me. I didn't like some of the language he used, but he's going to tell you straight up, this is the way it is.
Yeah. And I think a lot of people appreciate that because
Absolutely.
At least he is who he is. And that's why people either hate him or they love him. But let's spend some time here because you mentioned 2 things. One, I think everybody needs to invest their own capital as an LP first. So let's talk about that for a minute. What prompted you or led you to establish that belief?
Well, I didn't understand it fully at the time. Looking back, I can understand. I'm a application developer, right? So what I do is I go and write some code, and when I finish that code, I go test it, and then I go send it to somebody else to test before it gets into production. It never gets to production unless it's been well tested. It's no different here. That's what I was going through, but I didn't take its time out and say, I think I need to test this. No. But what I did think was important early on was I'm not going to put $800,000 in one deal. I actually thought I was at one point. There was a big deal that was supposed to refi in less than 18 months and give me a big chunk. The thing that I didn't realize at that time, I had not vetted that team. I saw enough red flags. I invested in someone that I knew. I confided in them. So I have some problems with this. They're more experienced. They said, those are good questions. I would ask the GP team. They didn't have answers for me. If they don't have an answer for a potential red flag, then you don't send the money. You don't commit. Vetting the team is just as important, if not more important, than vetting the deal.
I'm glad you said this, because this is one of the biggest mistakes that I see people in this industry, especially those that are newer, making, is that they get a pitch deck, it shows the returns, they get all excited about it, and then they jump into these deals without knowing that maybe that general partnership team has never done a deal together before. They may have met in a similar group and had complementary skill sets, but they're piecing this team together for the first time. And one of the biggest mistakes I see is people spending too much time vetting the deal itself. So one of our recommendations is we believe you should be spending 80% of your time vetting that operator, vetting that team, vetting the just doing your due diligence on who they are, their experience, their track record, and then 10% on the market itself, being the place where the asset's located.
Absolutely.
And then the third step is spending about 10% of your time vetting the deal.
Yep.
And one of my favorite quotes around the deal and numbers when it comes to underwriting, we were talking to a fund manager that's raised millions of dollars, and he himself said, I got so good at underwriting deals that even I started believing the numbers. I mean, think about it. When was the last time you ever saw a bad pitch deck? When was the last time you ever saw?
Yeah, they always accentuate and sometimes exaggerate the good things, and they oftentimes don't even talk about the bad marks.
And if you don't know what questions to ask, it can get yourself into trouble. And what I've also realized is that a bad operator can take a good deal in a good market and drive it into the ground.
That's for sure.
And then a great operator can take an okay deal in an okay market and manage it effectively, because that's where the money is truly made, is in the asset management piece. So for someone that's looking to partner with an experienced operator, if they want to get into this game of raising capital compliantly, I will add,
right,
what steps would you recommend that they take in vetting who it is that they partner with?
Yeah, for me, it was easy early on because Grant Cardone presented it. He had his track record clearly displayed on his website. I don't know, 12, 15 different properties. If you're bold enough to put that on there, even some of them had gone full cycle, which is a really good term. That just means that you've started, executed the business plan, and sold the deal. And so showing the world, this is my track record, this is what I've done, you can trust me that I'm going to operate well. That's what I did going forward. I did, in my opinion, my first 3 deals, I sunk $800,000 in those 3 deals. And what did I want to make sure of? What's your track record? I need to understand what that is. If you, in my opinion, the deal that I took a risk on, looking back, I don't think it was a risk, but it didn't feel like a risk. The deal was outstanding. But the operator, it was his first deal. And the second thing that I had, one of my closest mentors, his name is Ken Gee, shout out to Ken. He took me in, helped me understand underwriting the way most people don't. I'm a numbers guy. And he not only had his track record online, but he also shared with me some of the increased risks in this area. One of the number one things is floating rate, interest rate equals more risk. That doesn't mean it's a bad deal. That just means you have increased risk because you have a cap usually that you pay for insurance on that interest rate. And so the one deal that was so outstanding, I said, well, I like the operator. It's his first deal. I think I'm going to take a risk here because the upside is so strong. And it also had floating note. So it was a double risk for me, but I'd seen enough deals at that point, 4 months worth of deals every single week. He had already bought and sold a nutrition company. So he already, in my mind, knew how to operate, although this was a different space for him. I felt absolutely trustworthy. I felt like he was a trustworthy person. The other 2 had a track record. I wasn't worried about it. So sunk that money in because I knew not only had they done this before, they had closed the deals, sold them, and made serious money.
And what was the outcome of that? You took a risk, you took a leap of faith based on your analysis. Mm-hmm. What was the outcome of?
And I'm not a risk taker. I'm a security seeker. That's just my conservative nature. When I underwrite, there's ultra conservative underwriting, and there's kind of normal conservative, and there's people who think they're conservative who don't even know what an exit cap rate is. But the net of that is that's my very first deal that I jumped in. It was the third one that actually transacted. It's up for sale right now. It will be very close to 3x
Dang.
in almost 4 years.
And I think you mentioned some important things here, because there's a lot of deals that people have gone into trouble on with the floating rate debt. And you did your analysis, you felt comfortable with it, and so you decided to move forward, and it worked out well for you. And I think when it comes to underwriting, it's more than just plugging and chugging numbers, and that's what people need to understand. Even if you're not the one doing the underwriting, if you outsource that, you still need to understand the story behind the numbers. And so when you look at underwriting deals, whether it's real estate, and you and your business partner are getting into business acquisitions now, which we'll get into here in a minute, when it comes to underwriting, what story are you looking for, Dan, behind the numbers?
So, and this is a standard that was established because of the market that I was in when I started. So a 2x multiple, which is 100% return in the ballpark of 4 years, right? So they call it 3 to 5 years. One of the most impactful things that I saw, I was in a big event in Dallas, and there's a guy walking around with a book in his hand. I'm like, what do you have a book in your hand for? He opens it. It's got a dozen, maybe 15 checks. Lowest one is $198,000. Biggest one, just right under $500,000. Why do you have? He had cataloged 72 deals he'd been in. I don't do GP. I'm only an LP. Like what? He only lost money on one deal. He lost $5,000, put 100 in, got 95 out. His next worst deal, 33% over 3 years, 11% per year. That alone beats the stock market. That's his worst 2 deals, 72. He had the GP team. He had every number, like a numbers guy's dream. That's when this was probably 6 months in.
Hey, Dallon here. We'll get right back to the show, but I gotta share something with you that's been a complete game changer for us. Let's be real. Creating captions and content for social media can feel like a full-time job in itself. I used to post maybe 7 times a week. Now I'm dropping over 50. And it's not because I suddenly found more hours in the day. It's because of the one tool that changed everything. I spent a few $1,000s getting my own ChatGPT copywriter program to sound just like me. And now I'm giving you the exact step-by-step blueprint to program one yourself completely free. Why? Because honestly, I wish somebody would have done that for me. So go ahead, click on the link in the description or show notes below to access a step-by-step guide so you no longer have to let social media and a lack of online presence be the reason you're not raising more money. Click the link below. Now let's get back to the show.
All I got to know is the deal's good and the team's good. This is automatic if those 2 things are right. When you go to underwriting, though, you have to make sure that team knows how to do their homework. For most people, it's a scary word. What does that mean? Underwriting is just financial analysis. The 2 biggest blocker problem red flags is they don't know what real market rents are or could be for that, the upside. That's what we say, I call a rent premium, and they don't understand cap rate. You don't really have control of either one of those 2 numbers. Yep. You have to know the market well enough to know, we're at $800. That one deal, the one deal I took a risk on, average rents were right at $800. We put them to $1,350. That $550 premium is why I was okay with the floating rate. Did the floating rate go against us? Yeah, we had 7% cash flow for a year and a half. Cap rate got bye-bye, all the cash flow's gone. So we didn't have cash flow for about 2 years. It didn't matter.
Because you're going to make it up on the sale.
There was no capital call. We were not in risk. $550 a unit in increase. No rehab.
Wow.
Yeah. So that's what we're talking about. When you're underwriting, you're stress testing and making sure, is the deal going to sustain 1 or 2 things that you don't expect? And one of those would be rent. Rent goes stagnant or goes negative. Can you handle it?
So how is this superpower of yours in underwriting and understanding the numbers, how has this allowed you to be able to really build trust with different people, different personalities to a point where they're comfortable actually writing a check and investing with you?
I think that's easy because most people don't understand it. And so I'm a very open book, very transparent, very honest, and I'm going to tell you, here's the good things. if you're looking at deals and you have the freedom to go wherever you want to, just be aware they're not going to share this, that, and the other. When people hear you speak negative, some of my investors, they come to me regularly. I love your reporting because you don't just give me the good side. If there's a risk or a danger or something that's going on in the deal, you share it. I don't share it when it's a problem. I share it before it's a problem. So just be honest with people. They know it's not going to go perfect. No deal's ever going to go perfect. It's not always going to be good and rosy. There's going to be problems. That's why you stress test it. But if you're prepared for those and you know how to counteract those and mitigate those, that you can't ask for much more. That's what an experienced person who's been doing this for 30 and 40 years, they know. If something comes, they know how to counteract it.
And it's one of the most fundamental pieces to any deal, any business, any investment is being able to understand the underwriting. And if you're listening to this and you're like, hey, I'm not an underwriter. I don't want to be an underwriter. I'm not a numbers guy. Fine. Partner up with people like you, right? Like you, Dan. And that's a beautiful thing about this space. When you get into large real estate, large multifamily, it's a business at the end of the day.
Right.
And it's very, very difficult, I'd say impossible to operate that on your own. You have to have a team. You have to have different skill sets. And so for those listening to this, if you're like, hey, underwriting's not at all up my alley, fine. Like partner with someone like Dan where it is their superpower. So Dan, I want to transition into, actually before we do that, so you got into this and 6 months in, you started raising capital. Were you still working your corporate job at this time?
I still work it. In fact, I'm a security seeker until I have an absolute no shadow of a doubt I'm set. I'm not going to jump ship.
Okay, so your employer didn't cut you.
No, in fact, a year later they asked me to save the project with a different technology, and that.
So now they want you to speak up. Now they want your opinions. Interesting.
But I think that honesty and that openness, it also attracts people. As I'm speaking to them, they understand. Especially if you've known me for a while, when I say something, I'm not joking about it. Although I'm a joker, I love to laugh. But developing that trust is not just when you're talking about the deal. It's about other aspects of your life. You can't believe and be a false person or speak half-truths in one area and then that not translate to another area. So I'm a God-fearing person. I believe in reading the Bible. And one of the reasons that we'll probably get into Eddie Austin here in a little bit, his first question to me when I first met him, I was curious about why he said some things in the meeting on the microphone. His first question was, before we go anywhere, do you believe in God? And I'm like, Eddie, nobody asked that question. I was instantly attracted. I don't understand why he asked the question. I don't know if he asked that with everybody that he meets, but I'm a God-fearing person. If that's the starting point of where you're at, we already have a basis for trust.
There's alignment that's already established.
Through
those common grounds.
That doesn't mean that there aren't those people out there who I believe in God and I'm a Christian, read the Bible, who aren't fakes. There's always bad apples out there. But it gives you a foundation of trust to begin with.
And I think that's important to go off of, like, whether it's religion, politics, previous career paths, colleges you went to, finding those common grounds and areas. Some alignment helps set the foundation, but it doesn't mean that that's somebody that you should work with or you should partner with.
Or they're excellent in business.
Or they're excellent in business, right? Like none of that matters. But so it's good to establish that foundation, determine some alignment, and then from there you can grow. So let's talk about that a little bit. With you and your business partner, Eddie, you guys have some really exciting things coming up with JE Capital.
Yep.
So talk to us a little bit about, so you got started in the real estate space, you met Eddie, and now you guys are launching JE Capital or have launched it. So talk to us a little bit about that.
Yeah, so with the launch and interest rates going up so high so fast, there's basically been a very long, prolonged stalemate in the value add space. Most people are holding on because they have a floating interest rate or different variation of reasons. Rents have gone negative a little bit or stagnant. And so they don't want to sell because why? They set expectations for their investors and they can't hit them if they sell right now. So there's lots of holding on to. And so Eddie has a lot of history of construction and development. And so Eddie is huge problem solver. That's really what he is. And he's like, okay, if we're going to go from value add to development, what's the problem, right? When you have investors, there's usually three things they're looking for: appreciation, a money multiplier, cash flow, and depreciation. Well, usually only the mature investors are looking for depreciation. Most of them are always looking for either cash flow or some money multiplier. That's what we call the equity multiple. And so he's like, if we go into development, how do we provide the cash flow? Because that's the biggest inhibitor for an investor. I got to give you my money and I don't get it back for how long? 2 years, 3 years, 4 years? That doesn't sound good, right? Because what happens when you're getting nothing in return along the way? Doubt, more doubt, stronger doubt. Anything goes wrong, there's even more doubt. That's a problem. Whereas I know this for a fact. One of my early deals, I raised about $2 million out of the $8 million that we needed to buy the deal. We decided to do monthly distributions. As I don't care if it's in fact, my very first deal that closed, I got a check for 7 days of the quarter. It was $82 or something silly. Didn't matter. Why did it not matter? It was validation that what I just invested in is going to transact and pay me back. It's real. If you don't get any money for months and months and months and months and years, it can really build the doubt. So that was a real shot in the arm. The other deal that we bought, a deal out of San Antonio, we decided to do monthly distributions. The investors absolutely love it. It's a monthly reminder that we're executing the business plan.
And even if it's not an extravagant amount, it's validation, to your point, that the business plan is being executed.
Yeah, so we wanted to do a development deal. How do we provide cash flow in a development environment? Well, Eddie's brainchild. Eddie decided, let's buy a business that falls into the vertical build of the development deal that also provides cash flow. Buy a cash flowing business, whatever the percentage, 20, 30, 40, 50% of the deal of the business that provides instant cash flow. And so that's what we're doing. That's what we're executing.
So now people can invest into these businesses that are just going to support the development by the real estate. So now you are creating a vehicle in this machine that's going to provide appreciation, equity multiple. It's going to provide cash flow, ideally monthly checks, right?
Yep.
And depreciation or the tax benefits that are often associated with real estate.
Yeah, and the longer we go as we complete each one of these deals, we don't want to build anything unless we keep it permanently. We don't want to build a 24-unit deal that we're just going to sell. But as we keep these, we're able to sell these deals from one fund to the next. That increases our cash flow. It also increases the amount of depreciation we can offer.
Sounds like a compounding effect to me.
Absolutely.
So this vision and this partnership that you and Eddie are working on, what are you guys seeing as effective ways in being able to bring people into this vision with you?
Well, obviously the first basis for all of these new investors is trust, right? And so in this current economic environment, there is, I would say, a tightening of capital. They maybe want to invest in something different, but I think there's a lot of fear and questions about what is going to happen in the next couple of years. So a lot of people are just holding onto their capital, and those that are not, the basis of trust is absolutely through the roof. You have to establish that. There's a lot of doubt. I think that AI plays into that because there's so much fake stuff out there. I mean, there's people out there that are not real anyways. They promise and promote things that aren't real. And so when you come to the table and you say, we're offering right now, as we speak, 10 to 15% cash flow, what does that mean? You put $100,000 in, you get 10% cash flow. That's $10,000 per year. For most people, that's unbelievable. I haven't even talked about the 15%. You put in over 500 with us, you get 15% cash flow. That seems too good to be true.
But with businesses, if businesses are operated the right way, it's very doable.
It's very doable, and more. This will be the smallest cash flow that we offer.
People are so used to stock market returns, even doubling your investment in real estate and multifamily. That's a great return as well. But Paul and I, when we were raising capital for a deal, connected with somebody, a friend of his, he's known for years. This guy was in the software space, built software companies, sold it. I mean, we're talking millions of dollars, like mid to high, like 9 figures that he exited it with.
Nice.
And when we were talking to him about real estate, we're doing the pitch. Hey, double your money in 3 to 5 years. He's like, all right, cool. Thanks, guys. Like, I'll keep it in mind. We had no idea that people in the software space, they're not, 2X doesn't excite them. They're looking for that 20, 30, 40, 50X because that's the reality of some businesses. So I think what you and Eddie are doing is very much needed. And we've actually partnered up with somebody. I need to connect you guys anyways, because what you guys are doing is very much in line with what he's doing. Russell Gray, he has this big vision and this legacy he wants to leave behind about bringing voices back to Main Street businesses, getting money off of Wall Street into Main Street, getting it into the business owners' hands that are actually making a difference for people and creating jobs and opportunities. We're not talking about large corporations and that side of things, but really getting the power back to Main Street business owners. And that's really what you guys are doing, is not only being able to serve your customers with these businesses, but you're inviting people to come along for the ride and often be able to experience a better financial investment than they could if they had gone to a stock market or some other type of asset.
That's the most fascinating thing to me. About 6 months in, I learned that I can be a general partner. Grant doesn't really push that. He may talk about it briefly, but he just doesn't promote it a lot. Mostly because he wants to be your GP.
Yeah.
Right. He wants to invest in Cardone Capital. But when I realized I could be a general partner and raise money, you go through these different emotions. But what was really easy for me is I love helping people. And every single person that I offer this opportunity to, whether it's a syndication or a fund, I'm offering to help you. I'm offering to increase your returns, because you're not going to get anywhere close to 20 or 25% per year on anything you're doing in the stock market. The only way you can get better than that, as you referred to earlier, is a business, right? That's how you get increased returns. Most people don't want to do that because it represents a lot more risk.
And I think when people think of business too, they think of starting a business and that entrepreneurship journey.
Right.
You guys are buying cash flowing businesses.
Cash flowing.
So that's the difference between developing real estate ground up, where you're just taking dirt.
Right.
There's a lot more risk, a lot more moving parts. It's going to be a longer sales cycle, but it typically leads to higher returns. But then there's people that get into value add real estate. These are established projects and properties.
Right.
You can look at the transactions, how it's been performing, and then make minor tweaks. So that in itself mitigates a lot of risk. So I just want to emphasize that, because that's what you and Eddie are doing. You're not starting these businesses from scratch.
Absolutely not.
You're buying businesses that are already cash flowing, and you guys are bringing your skill sets, your systems, your processes in to make it more efficient, more effective.
Because we know we can streamline them and make them better.
Yes, which is in return going to generate more cash flow for you and your investors.
Yep.
And that's ultimately going to lead into even more efficiencies when it comes to the development side. So it's super exciting.
Yeah,
super exciting what you guys are building, and we're excited to be a small part of it and working alongside you guys. So as we wrap this up, Dan, the common theme that's come up quite a bit during conversation and most of these interviews we have is it really comes down to trust, right? You're a numbers guy. So ultimately, if you're looking at a deal, you're saying, show me the numbers, and then you're going to evaluate it. But the core reason for that is you need to be able to trust the numbers. You need to be able to trust the operator. So for people that are looking to invest into deals, people that are looking to place their capital somewhere, what's been your experience in one of the best ways to really build trust and connect with people?
I think to show the potential investor not only that you believe in the deal, that you know enough that they're not going to do as much homework as you're going to do, especially if you're the underwriter guy. They're just not. Many of my investors say, I don't know, I don't fully understand the underwriting, because I'm not afraid to send you my underwriting. Some people don't do that. I'm not afraid to send you the underwriting, but they don't understand it. What does it mean? Walk me through it. They don't know what questions to ask. They oftentimes will say, I don't fully understand the underwriting, but I trust you. Why do they trust me? I think it goes back to being transparent, open, and honest. That's how I am in everything that I do. Doesn't mean I'm not discreet, and there's those times to be discreet, especially in personal issues and items. But I'm an open book in just about anything. You talk about parenting. I have 5 children. 3 of them are already out of the house. You want to talk about it? I'm open, honest, and transparent about that. And when you are that way in many areas, they know who you are as a person. It's not hard to port over from parenting or Bible discussion or a study to a business deal. It's not hard. But when you're different people, you wear a mask in different parts of your community and your life, it's more difficult. So that's the bottom line. They want to know that you know what you're talking about, that you're an expert. They don't even, you can display a track record and it may or may not be true. They may or may not do homework to know whether it is true or not, but you want to appear as though you're an expert. That's what develops trust. And in my opinion, when you're pitching a specific deal or a business or something very specific, the level of your excitement translates to their belief. So it's not just about you've established trust, they trust you as a person. When you show that strong confidence and excitement about the deal, it's hard for them to overcome.
And it's consistent touch points. That's what we've realized. You don't build trust overnight. And I feel like too many people go into this capital raising game treating it like a one night stand where they're going in just looking to get a quick score. And that's not how it works. It takes time. And there's certain things that you can do and ways you can present yourselves that can help move people along that trust timeline. But it's really those consistent touch points. And we could have dove into this earlier. You mentioned AI and how that's coming into a lot of things. And a lot of people are starting to question, is that actually Dan speaking? Is that Dallon speaking? Is this podcast happening live in our studio, right?
Right.
So there's going to be those questions that are coming up, which by the way it is. I just want to clarify. But they say people need at least 8 to 12 touch points before they're comfortable taking that next step. Paul and I talk about this all the time. We think it's much more than that now because of AI, because of all these things. So it allows more people to be more places at one time. So there's so much more voices and noise, and trying to sort through that can be very, very difficult. So we believe there's a really good time and use for these tools, for these assets. That's why we have Capitalist Pro, right? It helps people stay top of mind and be able to show people how they could provide value. But at some point, it's got to transition into that personal connection. I mean, having you here in the studio, we're able to shake hands, connect, and it's like, oh, okay, Dan is the same person that we've been talking to online. And I think that's super important. So, Dan, what's one of the best ways that you and Eddie have found just to stay top of mind and be consistent?
Yeah, so I recently heard about a way to build trust as like a jar, and every time there's a transaction, it doesn't have to be a money transaction, some touch point, that's what you call it, you drop a marble in the jar. That's building that trust. You can't get a handful of marbles and dump them in there, but I do believe because of the AI and the proliferation of not completely true stuff out there, you can train a bot to sound just like you make phone calls for you. Because of that, there's more doubt in people's mind, and I believe live events is a touch point where they're literally grabbing a handful of marbles and dumping it in the jar. It's more believable because they know it's real. But you can't be live and real everywhere all the time.
Right.
And so how do you compensate for that? Capitalist Pro is the reason why. We record videos, we send out emails, whatever it takes, constantly touching people. If you can't send out emails on autopilot, you're not touching. And even though you're not physically touching, it brings you to their mind.
We lost a $200,000 investor not because he wasn't interested, but because we weren't staying top of mind. And that's really what launched Capitalist Pro for Paul and I, because we're like, we never want to make that mistake again.
Right.
And we don't want our users and people in our industry to make that either. So Dan, this has been a pleasure. It's been great having you here in the studio. Really excited for what you and Eddie have going on over at JE Capital. If people are interested in getting connected with you guys, where's the best place to send them? Or
just go to jecapitalinv.com. Our track records and stuff's on there. You can get our emails as well. So it's all right there at jecapitalinv.com.
Excellent. And we'll go ahead and put that in the show notes. So
sounds great.
Awesome. For those tuning in, hope you found some more value here in the Capital Flow podcast. Our guest, Dan, thank you so much for taking time. We'll catch you on the next episode.
Thanks, guys.